Hey, Karen Rand here back again, talking about angel investing and how you can create wealth by becoming an angel investor. So, yesterday I did a little live stream about Coinbase and all the big news and turmoil going on with the SEC investigating them and delisting the digital coins and stuff on their thing and kind of how they're going off after everything. And the big question was, why do I know about a crypto and hear about that as an investing versus angel investing? And in the course of that, I had said, well, and angel investing has been illegal for the last, I said 90, but really, when you look at the math, it's about 80 years, right? So then questions came in. What do you mean illegal, Karen? So this is about that. Go watch the Coinbase one after you watch this. So here's the thing. Technically, it's not that investing in entrepreneurs was illegal because the burden was on the entrepreneur, right? The burden was on the entrepreneur. But the nature of how these things evolve over time, it creates what do you call it? A vacuum in the marketplace, a vacuum of information that gets filled with something else for self-serving purposes. So just to give you some dates and context, right? So after the Great Depression, because of the stock market collapse that triggered the Great Depression, the SEC said, and part of that was because of transparency. The SEC was not requiring companies to be transparent and filing with them on their financial health in order to protect investors. There was no SEC, in fact, back then. It was just a free-for-all. So they were just buying and selling. So, and boiler rooms and all this kind of stuff. So in 1933, they established the Securities Act, which set up that companies would have to file if they were selling equity or buying and selling any kind of equity. They would have to file on a regular basis and be transparent. And so, and that really put the burden on the company. And they had to, and then they had to invest with people that they knew. Okay, if they wanted an exception of it. So legend has it that the Titans of industry, the Gettys, the Rockefellers, all this stuff, they wanted to continue. There was an industrial age was going on. They wanted to continue to invest in each other's projects and make a lot of money because they were all investing in each other, building, America. And so they were, and so they wanted to be able to do that without government scrutiny. So 1934, the Securities Exchange Act established the SEC, established the Reg D provisions that said you can, if you have a prior relationship, you are exempt from filing any paperwork with the government about this, right? So that went on for a long time. That was how that worked. And then you started, and it established NASDAQ and the New York Stock Exchange. And then it established, evolves, as everything evolves around, and they started to put in criteria of who could invest because their goal of the SEC, their intention is to protect investors. And so when you had the rise of the tech companies from the 60s and 70s into the 80s, they started to establish these provisions, and that established what accredited investor was. And it's changed over time, but not a whole lot. Biggest thing was the $1 million in assets now doesn't include your primary residence, but income, really from an inflation standpoint and stuff like that, it's actually pretty easy to qualify as an accredited investor these days. And so they set forth these rules. And that's when angel investor groups started because they had to have the angel, whoever's running it, that established the prior connection because otherwise broker dealers, if you didn't individually know that, broker dealers established that connection because it was their clients, but only big companies would raise capital through broker dealers because one of the rules is to treat everybody the same. So you couldn't take in a deal and only offer it to 5 people. You had to offer it to everybody. So by the nature of that, you have 1,000 clients, you got to have a lot of money to be raised. And they raised it with big amounts of money, also excluding people that didn't have a lot of money to invest, right? It was just sort of this natural evolution, because of economies and scale. People that buy bigger pay more, less of them, and I can reach my goal. And so it went on like that. And so what ended up happening was smaller startup companies that are raising that first million, couldn't go through broker dealers, couldn't go to people that they know because they most of us don't know a lot of millionaires and like to pick up the phone and call them. So they went through angel groups. Angel groups, like I say, in my whole story, when I first discovered angel investing, it was like this secret society of these people that were picking and choosing the deals that they were going to be the best deals and be the next big thing, right? Because they would come in, they had exclusive rights to look at that because they couldn't go anywhere else. And it became very hard in some cases to raise capital, and sort of the nature of evolution of business, evolution of asset accumulation. It's just natural that most of the people in that room did not look like me, and did not look like people of color. They were basically white men. It's just the nature, right? Women couldn't get a loan on their own name until the Supreme Court ruled that it was illegal to judge them for not being able to get a loan by their sex. It had to be on financial. Because prior to 1984, I had to have my brother, my son, my husband, my dad co-sign for me if I wanted to buy a house, if I wanted to have a business loan, if I wanted to get a credit card. Right? So, there's been this evolution of segments of our population that have been not included, let's just say, not so much excluded. They just weren't included in the growth of what created the middle class and the upper middle class. So we now have the ability within the Jobs Act for entrepreneurs of any type to be able to solicit investment from any type of investor. There are rules about how much you can invest based on your income, but anybody can invest in these things that have the potential to go really big nowadays, and entrepreneurs can solicit. Now, whether they're successful in all that stuff is a whole nother conversation, but that was what made it legal. Okay, because the entrepreneurs could solicit, and it didn't have to go through this prior relationship. So now anybody they know can put money in it. And that's what made it legal, because you wouldn't have been able to put money in it unless you were in one of those groups or already knew that entrepreneur and were already a millionaire. Right? So that's, you couldn't. There were exceptions under Reg D, which I go into with my class. This is where I talk about all this stuff. It is Reg A plus, Reg CF, Reg D. All of that stuff sounds like alphabet soup to you. And all of this stuff is, wow, Karen, go to dothedeal.org. Get in on the free pre-sale before this goes live, because you will get access to the content and the resources that come with this book and a digital version of this book that will all be a fee-based subscription in the future. Right now, pre-sale, free. To go to dothedeal.org. Sign up for when that's going to be ready in the next 10 days, let's say. All right. So do you understand? So what filled in the gap when all these people were being excluded from being able to invest because they didn't have the financial means, they didn't have the connection, they didn't have a seat at the table, they weren't invited into those angel groups to be part of that. They weren't invited if they had a financial planner, if they wanted to invest in these things. Because the way the rules for the FINRA and it wasn't FINRA at the time, NASDAQ at the time, but broker dealers, right? Is that if a company, if I went to my broker dealer, if I went to my financial planner and I said, hey, I want to invest in this, can you tell me if I should do this or not? They would say, you can't, no, that's not a good investment. Don't do that. You should invest in real estate. You should invest in stock, because they got paid on the stock and real estate wasn't considered a security. And they were in fear of losing their license if they said anything about a private equity transaction, an angel investor transaction that did not go through their broker dealer. And I already said you had to have the big deals, right? So what did they fill the gap? They filled the void, that void in the air of what to invest in with real estate and stock. And even real estate wasn't the thing until the 80s when the laws changed for that. And you could get a mortgage on an investment property and you could deduct your taxes. So everything really started changing in the 80s. But anybody, think about it. People save up money all the time for real estate to build a portfolio of real estate, not realizing that in the money that they invest in one real estate property, they could invest in probably 10 companies on a crowdfunding platform. and they could have a diversified portfolio that will produce significant more return than that real estate property is when you factor in all the costs and risks associated with real estate. Same thing with stocks. Stocks go up and down all the time outside of your control. You have no control over it. And they're already here. So the odds of them going down are pretty high. Whereas private companies are always going up with the money. Okay. So my video tomorrow is going to be on comparing it specifically real estate or stocks. You're watching this, put in your comment. Which one do you want to hear about first? Real estate or stocks? Angel investing compared to real estate and stocks. You say it's 3 times more profitable. How is that, Karen? And I'll throw some stats at you and some history and all the good stuff that I like to do. And thank you for tuning in. Thank you for watching. Onwards and upwards. Go do the deal. See you tomorrow.